In finance, risk management is essential for safeguarding an institution's assets, maintaining compliance, and ensuring profitability. With modern advancements in technology and data analytics, financial institutions have developed sophisticated tools and methods to identify, quantify, and mitigate various risks. This chapter explores 5 core aspects of risk management: credit scoring using big data, fraud detection techniques, operational risk analysis, market risk and portfolio management, and regulatory and compliance risk monitoring. Credit scoring using big data. Credit scoring is a vital process for assessing the creditworthiness of individuals or businesses. Traditionally, it relied on a limited range of financial indicators, such as credit history, income, and debt-to-income ratio. However, big data has significantly transformed this process, offering a more comprehensive and nuanced view of a borrower's financial behavior. Big data enables the integration of a wider variety of data points, such as utility payments, rental histories, social media activity, and mobile phone usage patterns. This expanded scope of data helps create a more accurate assessment of an individual's or business's financial reliability, particularly for those who may not have a robust traditional credit history, like young adults or immigrants. Machine learning algorithms are critical to leveraging big data for credit scoring. These algorithms analyze vast data sets, identifying complex patterns that traditional models might miss. For instance, an individual with limited credit history but consistent payments toward rent and utilities can be seen as more reliable than someone with a higher income but erratic payment behavior. Machine learning continuously improves the accuracy of these predictions by learning from new data inputs. This approach promotes financial inclusion, providing access to credit for individuals who might otherwise be excluded from traditional scoring systems. However, big data in credit scoring presents challenges, particularly around data privacy and bias. Institutions must navigate stringent privacy laws like the General Data Protection Regulation, GDPR, and ensure that biases in historical data do not perpetuate inequalities in lending practices. Big data in credit scoring has revolutionized how financial institutions evaluate creditworthiness, offering more accurate and inclusive assessments. However, ensuring transparency, fairness, and regulatory compliance remains critical to its success. Fraud detection techniques. Fraud detection is a major challenge for financial institutions, as fraudsters continually develop more sophisticated methods to exploit vulnerabilities. Advances in data analytics and machine learning have provided financial institutions with powerful tools to detect and prevent fraudulent activities more effectively. Pattern recognition is a widely used fraud detection technique. It involves analyzing transaction data to identify behaviors that deviate from an individual's normal spending patterns. For example, if a customer who normally makes small local purchases suddenly initiates a series of large transactions overseas, this could trigger an alert for potential fraud. Machine learning algorithms are increasingly at the forefront of fraud detection. These models are trained on historical transaction data, learning to distinguish between legitimate and fraudulent activities. Over time, these algorithms adapt to new types of fraud, improving their ability to detect suspicious behavior. For instance, machine learning models can identify patterns associated with credit card fraud, such as unusually high spending or purchases made from multiple locations within a short period. Another important tool is network analysis, which examines the relationships between accounts, transactions, and entities. By mapping these connections, institutions can uncover more complex fraud schemes, such as organized groups engaging in coordinated fraudulent activity across multiple accounts. Anomaly detection is another key component of modern fraud detection systems. It involves establishing a baseline of normal activity for each account and flagging deviations from this norm. For example, an unusually large withdrawal or a spike in online purchases might signal potential fraud. While technology plays a crucial role, human oversight is still essential. Automated systems can identify suspicious activity, but experienced fraud analysts are often required to make final determinations, particularly in complex cases where legitimate transactions may resemble fraudulent ones. Fraud detection is a constantly evolving field. By combining machine learning, pattern recognition, and human expertise, financial institutions can stay ahead of fraudsters and protect their assets and customers. Operational risk analysis. Operational risk refers to the possibility of losses resulting from failures in internal processes, people, systems, or external events. For financial institutions, operational risks can range from system outages to human errors and cyber attacks. Operational risk analysis is a structured process that helps identify, assess, and mitigate these risks to ensure smooth business operations. The first step in operational risk analysis is risk identification. This involves conducting thorough audits of internal processes to identify vulnerabilities. For example, a bank may review its loan processing system to pinpoint areas where human errors or technological failures could disrupt operations. Once risks are identified, the next step is risk assessment, which evaluates the likelihood and potential impact of each risk. Tools such as scenario analysis and stress testing help institutions simulate various risk scenarios, providing insight into the possible financial and operational consequences of different risks. After risks are assessed, institutions implement risk mitigation strategies. These might include investing in redundant systems to ensure business continuity or conducting employee training programs to reduce the likelihood of human error. Regular training ensures that staff understand potential risks and are prepared to manage them effectively. Continuous monitoring is crucial for maintaining effective operational risk management. Risks evolve as market conditions change and new technologies are introduced, so institutions must regularly update their risk assessments and adjust their mitigation strategies accordingly. Operational risk analysis allows institutions to anticipate potential disruptions and respond proactively, safeguarding their operations and customers from unforeseen events. Market risk and portfolio management. Market risk, also known as systematic risk, refers to the potential for losses due to fluctuations in the broader financial markets, such as interest rate changes or economic downturns. Portfolio management focuses on balancing risk and return to achieve long-term financial goals. A key strategy for managing market risk is asset allocation. By diversifying investments across different asset classes, such as stocks, bonds, real estate, and commodities, investors can reduce the overall volatility of their portfolio. For example, bonds often provide stability when stock markets are volatile, helping to mitigate potential losses. Diversification is another essential technique. By spreading investments across various sectors and geographic regions, investors can minimize the impact of poor performance in any one area. For example, investing in both technology and healthcare sectors can provide protection if one sector experiences a downturn while the other thrives. Derivatives, such as options and futures, are commonly used to hedge against market risk. These financial instruments allow investors to protect their portfolios from potential losses. For instance, put options can be used to offset declines in stock prices, providing a safety net during market downturns. Investors and fund managers often employ scenario analysis and stress testing to simulate the impact of various market conditions on their portfolios. These tools help anticipate potential risks and adjust investment strategies to mitigate losses during economic turbulence. Maintaining a disciplined investment strategy and staying informed about market trends are key to managing market risk and achieving stable returns over the long term. Regulatory and compliance risk monitoring. Regulatory and compliance risk arise when financial institutions fail to adhere to the laws and regulations governing their operations. In the highly regulated financial industry, non-compliance can result in severe penalties, reputational damage, and even the loss of business licenses. Regulatory and compliance risk monitoring is essential for ensuring that institutions operate within the law and meet their legal obligations. The first step in managing compliance risk is establishing a compliance framework. This framework outlines the relevant regulations and the processes in place to ensure compliance. Many institutions have a Chief Compliance Officer, CCO, responsible for overseeing compliance activities, conducting audits, and ensuring the institution adheres to legal standards. Employee training is crucial for maintaining compliance. Financial institutions must regularly educate their staff on new regulations and ensure they understand the importance of compliance in their daily work. This helps reduce the risk of unintentional violations. Technology also plays a significant role in compliance risk monitoring. Compliance software can automate many tasks, such as tracking changes in regulations and auditing internal processes. For example, anti-money laundering (AML) software monitors transactions in real time to detect suspicious activity and ensure compliance with financial regulations. Regular audits are necessary to identify compliance gaps and ensure that institutions remain compliant. Engaging with regulatory bodies and maintaining open communication can also help institutions stay informed about upcoming regulatory changes and avoid compliance issues. In a globalized economy, compliance risk monitoring is especially challenging for institutions operating in multiple jurisdictions, each with its own set of regulations. However, effective monitoring is crucial for avoiding legal penalties and maintaining trust with stakeholders. In conclusion, effective risk management is essential for financial institutions to navigate the complexities of today's financial landscape, from using big data and credit scoring to employing advanced fraud detection techniques, conducting operational risk analysis, managing market risks, and ensuring regulatory compliance. Financial institutions must be proactive in identifying, assessing, and mitigating risks. By leveraging technology, data analytics, and human expertise, institutions can protect their assets, comply with regulations, and position themselves for long-term success.